Every new trader starts their journey by searching for the same thing, a mathematically perfect setup that guarantees a profit every time. The hard reality is that a 100% confirmed trade is a fantasy. Making financial decisions based on a single technical indicator is mathematically identical to gambling. If certainty is impossible, we have to look at how professional traders manage to consistently hit targets with 70 to 80% accuracy. This accuracy comes from the Confluence Zone, a specific coordinate on a chart where the psychology of the masses happens to align. Mastering the market isn't about predicting the future with lines on a screen. It's about identifying these rare moments of mass human agreement. Millions of people are buying and selling at any given second. To understand how Confluence generates movement, we have to divide these traders into distinct factions based on how they read a chart. The first group maps the market using horizontal levels. They look for specific price floors and ceilings. If a stock hits one of these historical flat lines, they make their move. The second group ignores flat lines. They draw diagonal trend lines to track the market's trajectory, buying or selling whenever the price touches that angled slope. The third group zooms in to the microscopic level. They ignore the broad lines and look solely for specific shapes in the data, like a double-top candlestick pattern. Usually, these three groups act at different times. They buy and sell independently, creating the random noise that confuses most investors. In a downward trend, the price often drops through a support level and then climbs back up to test that same line from underneath. The first faction sees this old floor become a new ceiling, and they immediately prepare to sell. Now, look at the same chart through the eyes of the second group. By connecting the previous peaks with a diagonal line, we see the price is hitting that exact same coordinate. Zooming in even further, the third group spots a bearish candlestick pattern forming right in those crosshairs. Three isolated groups, using completely different methods, are all executing sell orders at the exact same millisecond. Because all three factions are now acting as one, the resulting volume creates a significant downward force. This overwhelming sell pressure pushes the market toward the profit target with a reliability that single indicators can't match. Even a perfect confluence zone can fail. The price abruptly breaks in the wrong direction, hitting your stop loss and ending the trade. Crowd alignment is powerful, but it can be destroyed instantly by unseen macroeconomic forces or massive institutional algorithms. This is why even the best strategies have a 20% failure rate. This leads to Rule 1, risk management. Confluence feels so accurate that it's easy to feel invincible. After a few wins, traders often discard their discipline and double their position size on a single trade. The math is unforgiving. Risking too much means those inevitable 2 or 3 losses will completely wipe out a portfolio, erasing weeks of careful gains. Rule 2 is patience. Because Confluence requires multiple factors to align at once, valid setups are rare. You must be willing to wait days for one high-probability signal rather than overtrading. By accepting that the market is inherently chaotic and waiting for the rare moments when the crowd agrees, you stop gambling. You begin operating with the calculated precision of a professional.